FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. This is the Financial Survival Network. I'm Kerry Lutz. It's 2/26/18. February's almost over. February, a month of correction, not just by the stock market, but by the Fed. Well, you'll find out more about that up next with John Rubino. But first, as always, join us. We welcome your participation in the show. Just email us at kl@kerrylutz.com. So the more things change, the more they stay the same. The Fed, could it be changing course? Well, John Rubino, you're with us. Make sure you go check out John's site, dollarcollapse.com. John, happy Monday.
Hey, Kerry. First of all, excuse my voice. I've got a little cold today, so I might be clearing my throat once in a while. And this froggy thing is because of that, not because I took up smoking in the last week or anything. But
all right. Well, we'll let you go this time, and Melissa will be on the lookout for coughs and such, and we'll just cut it out for you. Okay.
Excellent. Okay. So the Fed is, I guess, the big story in the markets now because stocks are way up, and the dominant story relating to that is that Jerome Powell, the new chairman of the Federal Reserve, just said that he would tolerate higher inflation for a while in order to maintain the recovery or keep the expansion going. Which is kind of sort of what people have been looking for ever since the stock market started getting really volatile. There was a number on the decline of the Dow and the S&P that would cause the Fed to do something to try to manipulate the markets. And it turns out that maybe a 10% drop was about enough because the Fed has now come out and said, don't worry about us tightening excessively in the short run. We will tolerate inflation that's above target for a while. And that was always to be expected. Sooner or later, they were going to have to reverse course and come back in with massive QE if the financial markets started to drift down into a much overdue bear market. Because this has been really the longest stretch of steady increases in stock prices that we've ever seen. And the reason for that is government manipulation. We've been pushing interest rates down to artificially low levels, which makes stocks seem artificially attractive relative to, for instance, bond yields. But over the past 6 or so months, bond yields have been starting to go up, which has made stocks less relatively attractive and caused huge volatility in the markets. The Fed feels obligated to respond to that because the system is so highly leveraged now with all the debt that we've taken on that instability in the markets, which used to be something that was just, commonplace and the real economy was barely even affected by equity bear markets. Now it's something that's systemically risky. The actual system is existentially threatened by a bear market in equities. So the government, led by the Fed, feels obligated to intervene on very short notice. With just a 10% drop in stock prices, here they are saying, well, we'll take higher inflation. Don't worry. We're going to keep the expansion going, which of course leads to imbalances in other areas. If we take 2.5% or 3% inflation for the next few years, then all of a sudden a bond yielding 1 or 2% or even 3% has a negative real yield. And what does that do to the fixed income market? It causes the instability that existed in stocks over the past few months to migrate over to fixed income, and or to the currency markets, where who wants to hold the currency of a country that's accepting 3% inflation? As far as the eye can see. So we trade a currency crisis for a stock market crisis. And all of which means that there is no free lunch. If you do something that creates instability, then there will be an instability somewhere. And you can try to tamp it down in one area of the system, but it's going to bubble back up somewhere else. So this just leads to, at some point, a dollar crisis. In other words, accepting higher inflation is part of the currency war scenario in which we actively devalue our currency in order to gain a trade advantage in order to keep the economy growing. That disadvantages our neighbors. our trading partners, and they suffer for our financial mismanagement, which leads them to respond in kind. And then you get this kind of race to the bottom in currency values. That's the currency war scenario. And accepting higher inflation is one of the weapons in a currency war. So we're seeing it play out kind of according to script right now.
Mm-hmm. So this isn't surprising, though, really, is it?
Well, some kind of Fed response to the instability in the stock market is absolutely not surprising because, over the past, what is it now, 30 years since the 1990s? That's been Fed policy. Anytime there's any kind of an incipient crisis anywhere in the world, really, the Fed intervenes by cutting interest rates, by increasing the money supply, by giving loan guarantees to threatened sectors, and now by tacitly or explicitly accepting higher rates of inflation. So this is all part of the process that began with Alan Greenspan back in the mid-1990s. When he started bailing out everybody in sight every year, there was a new crisis, and then he would step in and save the big banks. And then next year, another crisis, and he would save the big banks again. That told Wall Street basically that they can do anything they want to and pretty much get away with it. So this should be seen as part of that process, just continued with some new terminology and new faces among the talking heads. But it's basically exactly the same thing as we started doing in the 1990s.
So effectively, you're saying is Yellen's gone, but Yellen lives on.
The chairman is dead. Long live the chairman. Basically, it doesn't matter. These are interchangeable parts at the Fed. They're all the same people. They went to the same schools. They hang out at the same clubs. They have dinner together. They teach at the same universities. They work in the same bureaucracies. And they all believe the same thing, which is that government should actively intervene in the markets in order to smooth out the fluctuations and to keep growth going, which is
the opposite of what you and I believe, obviously, right?
Yeah, it's profoundly wrong on so many different levels. Because markets have a function, to these guys who are running monetary policy now, markets exist as public policy tools in order to get people to borrow and spend. The more you can push the stock market up, the more excited people get, the more likely they are to put a night's vacation on their credit card, and the more likely the economy is to grow in the moment, when that vacation gets taken. They ignore the amount of debt that accumulates during this process, and that debt eventually becomes a fatal flaw in the system. And we have taken on so much debt over the past 30 years that it's completely unprecedented in scale, both nominally and relative to the economies that are taking on the debt. So in that sense, it's unprecedented. But in a more relevant sense, we've seen it all before. Countries have borrowed tons of money before. And in each and every case, they've had some kind of a crisis that's either related to their currency or to the collapse of the leveraged financial system that they'd created. And so it's reasonable to think that the whole world is headed for something like that as we take on absolutely insane amounts of debt. The guys in charge of monetary and fiscal policy around the world don't get this, though. The U.S. is now 8 years into an economic expansion, is ramping up fiscal stimulus as well as the Fed now talking up monetary stimulus. We're setting up policies where we've cut taxes and we're increasing infrastructure and defense spending in a way that'll give us $1 trillion deficits basically forever. And that's a lot of debt for just the government to be taking on. So in order to manage that debt, they've got to keep interest rates low, which is another way of saying they've got to encourage the private sector to borrow huge amounts of money and then spend it in the moment, which generates taxable income, which raises the tax take of the government, which lowers their need to borrow going forward. It keeps it around $1 trillion, in other words, if we can maintain growth. But, massive increases in private sector debt are also destabilizing. So that's not a long-term fix. That's basically just get us through the next election cycle, and then we'll let our successors worry about it. So that's the way it's been with the people running the Fed. That's just a job interview, an extended job interview in which they show the banking system that they can be good team players so that they get hired afterwards. As we talked about before we went live, Bernanke now works for a high-frequency trading hedge fund.
Yeah. Well, if you can't beat them, join them, right?
Yeah, I mean, that's basically a criminal enterprise that front runs and gets away with it because they own the regulatory apparatus. And so now you've got the ex-head of the Fed who made minuscule money, a couple $100,000 a year while working at the Fed, now probably makes millions of dollars a year as the benign face of this high-frequency trader. And that's how it works at the Fed. You don't go there for the money. You go there for the immediate prestige, for being on CNBC and Face the Nation and stuff like that, and for the serious money that comes afterwards when all the friends you've made on Wall Street start offering you big-time jobs. I think it's fairly clear that this isn't even implicit. This is probably explicit. When somebody takes over the Fed, he's still hanging out with his friends on Wall Street, and they're still telling him, you know what? Help us out this year, give us lower interest rates and, help us generate a lot of profits from our prop trading desk. And we will totally make it worth your while when the time comes, and I'm sure they literally say those words, but they don't have to. It's kind of understood within the regulatory agencies now that if you're regulating an industry, you're basically interviewing for a job with that industry at some later point. And, the Fed is just the biggest example of that. Everywhere else, it's the same thing. Which is why we should expect policies from the Fed that benefit Wall Street and sometimes only Wall Street or Wall Street and the political class. It helps incumbents get reelected too.
Oh, sure.
So, you leave the Fed and you go be a hedge fund guy or a consultant or a lobbyist or something like that, and you make huge amounts of money. That's just the way the system works. So they're not going to bite the hands that feed them. And Powell's recent statements are just another example of that. They'll do whatever it takes to maintain stability. But, and this is the important part, beyond a certain point, you can't maintain stability. There's a certain level of debt that blows up the system. All we're doing now is establishing what that level is. We don't know ahead of time what it's going to be. We'll only find out after the system blows up, and we'll look back and go, oh, yeah, it was 400% of GDP. That was the level of debt we can't get beyond. We'll find out. But I suspect we're pretty damn close to it because we've taken on so much debt that going much beyond this just guarantees increasing volatility in the markets until it all blows up. We'll see.
And blow up, it will, no doubt. Well, it's just not going to happen the way that we expect it, though. That's the thing. It's going to happen in a whole different, for some reason, nobody's going to see it coming except you and I, right? Well,
the day it happens, of course, nobody really, because you can't know until after the fact whether something like we had earlier this month, 1,000-point drops in the stock market, whether that's the beginning of the end or just a squiggle, which generates a response from the Fed, which sends stocks back up. That could also be the case here. So we can't know, except with hindsight, what exactly is the end, what brings it about. But I'll tell you what, those 1,000-point drops in the stock market, that's how it will look when the end comes. And it'll be more than that. We'll see the stock market drop to the point where they have to close the market to staunch the bleeding for a while. And we'll see gold and silver go up, $100 in a day in gold and $10 a day in silver. And we'll see the bond market reel from interest rates spiking. All of this is coming where bonds actually drop by, say, 5% in a day, which is an extremely big move for the bond market because interest rates are spiking. And since the bond market is much bigger than the equities market, that kind of a move costs trillions of dollars around the world. Mm-hmm. So, remember the talks that we had a while ago when stocks were tanking and the world's richest people were losing, tens of billions of dollars on a daily basis, although it was just a small dent in the trillions that they own. But it was a really big number for the world's billionaires to be losing. That's also going to be front page news when the time comes.
For sure. Hey, so what about China? We've got like a tin horn dictator there now, it seems. President for life. The only thing that's missing is the military uniform with all the medals hanging from it.
Well, China is the latest in a long tradition of authoritarian countries that look like they're the future. To put this in context, you have to go back to the early 20th century when the Soviet Union was moving people off farms and into factories and generating huge amounts of quote unquote growth. And a lot of people were going there to visit and coming back and saying, I've seen the future and it works. We were terrified that system was going to outcompete us. And of course it didn't. It failed miserably because dictatorships aren't flexible. So they look good while they're going linear, but as soon as the world goes nonlinear, which it does every once in a while, dictatorships fail. Then in the 70s and 80s, it was Japan who had this kind of top-down bureaucracy that allocated resources between its different industries. And they were doing great. And we were terrified that they would just, build this robot workforce that would take over the world. And that failed too. They borrowed a bunch of money and they borderline collapsed. And now they're sort of a zombie country. It's just kind of borrowing more and more money each year just to maintain the social services that their aging population needs. So China is the latest in that series of countries that we're terrified of because it looks like their dictatorship is super efficient, and we can't compete with that because democracies are so messy. And so what they did lately was they just did away with term limits on their president, the head of the Communist Party. So he now is effectively dictator for life. And at the same time, they're instituting something called a social credit score, which is, a fascinating high-tech version of George Orwell's 1984. How we have credit scores here in the U.S. And that number tells people a lot about you, but it's just about your creditworthiness. Well, they've extended that concept to everything you do online. And they make it a social credit score. In other words, how good a person are you? So if you, for instance, donate money via some, online app, you get extra points for that if you donate money to a good charity. However, if you play a lot of video games or watch a lot of porn online, you get negative points. And presumably, if you speak out against the existing power structure, you get lots of negative points. And if you get a sufficiently low score, you're really penalized by that. You can't take first-class travel in China, for instance, if you've got a low score. You can't get credit. A lot of places just won't let you shop there. And it's a public number. So you're shunned by your friends because if you have friends with low credit scores or low social credit scores, it lowers your score. So you get shunned by everybody if you have a low score. Nobody wants to be seen with you. You're like the unpopular kid on the playground that you're penalized for hanging out with in school. Well, then now they've got a whole country that has the same kind of system. And it's a really profoundly powerful method of social control because you don't really have much recourse. If your score drops, you can't go to some independent agency, say, hey, you know what? That's a mistake. Move my score back up. They say, sorry, it is what it is. Or they just don't even take your calls. And so when the government's mad at you in that kind of a system, they can basically shut you out of public life. And the technology exists for that now. Mm-hmm. So the scary thing is that we could easily emulate something like that here, where you tie in somebody's, Facebook activity, along with their LinkedIn activity, along with their emails, along with their texts, and their, traditional credit score related stuff to end up with a score here that puts you totally at the mercy of the government. If they want to manipulate that score, they will totally do it. Because, they already manipulate the financial markets now. So manipulating somebody's social score is a tiny little step from where we are now. So this is something that we need to watch and need to pay attention to.
That's for sure. Hey, well, they could be doing it here in the U.S. and we wouldn't even know about it. There are so many scales for figuring out your credit, so many credit scores, and there could easily be these social scales as well, although perhaps not directly at the behest of the government, but certainly it can be done with all the involuntary tracking that's taking place on your computer. No fewer than 50, 60 different entities are tracking your computer usage at this moment, no matter who you are, unless you've blocked out all cookies, which is going to create performance issues for your computer, for your browser window. I guess you could be using the Tor internet browser, and that will help somewhat. But what are you supposed to do here, John?
Well, I think that's going to be a big issue for the survivalist side of things. People who are taking steps to protect themselves from what they see as a crisis of some sort. The whole online privacy thing, and there's a book by Kevin Mitnick, the most famous hacker in the world, called The Art of Invisibility, which I own. I haven't actually read it yet, but it's sitting there, and he shows you how to erase yourself from view of a lot of these systems out there that now track what you do. As you said, they track pretty much everything you do online. And it's just waiting for those databases to be combined into one database that has a score, that defines your life. So one of the things we'll have to start paying attention to is how to minimize your footprint out there and how to make yourself as invisible as possible to the people who are spying on you, with your tacit approval now, like you said, through cookies and on Facebook and stuff like that. Facebook is doing something which I might be getting myself into trouble by speaking about it without completely understanding it, but they're ranking the trustworthiness of news sources and of posts by their users now. And if you have a trustworthiness score on Facebook, that's not far from the social credit score that we're talking about in China, right? If Facebook has the ability to arbitrarily say that you're not trustworthy, that's a big problem for you. And apparently they do have that ability now, So this is going to be an issue that is going to be discussed within libertarian circles and civil liberties circles going forward. And I think it's probably worthwhile getting to know the issue and learning the details of it to be able to participate in that discussion when the time comes, because the outcome of it is a very big deal. Are we going to have something like what China's building now? Or are we going to put safeguards in place that prevent that from happening and make it absolutely impossible for a centralized database to ruin your life with a single number or a single term? And hopefully the good guys win this debate, but in this world, it's not clear that that's a high probability outcome. We'll see.
It's still early in the game here. Nobody can really tell who's going to win or lose, but it's interesting because at least when you have an error on your credit report, there is a system that you can follow, and you can go to sue people in court as well. If there's something really egregious or really bringing your score down. I wonder with these social scores how easily you're going to be able to do it. And the other thing, John, is the other scores that they're using, the other scoring systems, which are financial at this point, you don't even know about most of them because they're never disclosed to you. And I guess unless somebody makes a credit decision using it, they don't have to disclose it to you. So you might not even be getting offers, great financial offers, that you would otherwise be entitled to if they had the correct score on these other rating systems. So you can be damaged right now and not even know about it.
Oh, yeah. But as far as a credit score goes, a low credit score is kind of a blessing in disguise because it makes it harder for you to borrow money.
Very true.
So I think that as far as that goes, it's, that's more like tough love than anything else. But once it extends to, your political activities and your online search history and stuff like that, that we're getting into a very, very dangerous piece of territory. So, yeah, we need to pay attention to this. Yes. And China, because it's the world's most successful dictatorship, definitely bears watching because it's blazing the trail that Japan and the Soviet Union once blazed in terms of government control over the populace and the debate over whether the resulting efficiency is a good thing or a bad thing,
Very true. Well, hey, keep your eyes out for rating systems because you're going to be rated at some point, and our rating is up right now. We got to go. Just check out John's work over at dollarcollapse.com. Check us out at financialsurvivalnetwork.com. Sign up for both our newsletters, Twitter feed at Kerry Lutz. the Facebook page Financial Survival Network. John, we'll talk to you next week.
Thanks, Gary. See ya.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.